In the world of modern personal finance, there is an accepted norm that destroys wealth more effectively than almost anything else. We are told that having a monthly car payment is just a normal part of life, like paying a utility bill or buying groceries. But today, we are going to expose the hidden mechanics of the modern car loan. We are going to look at the math, the psychology, and the devastating opportunity cost of the car payment trap that nobody talks about. Welcome to Bruce Invests, where we explore the practical, often invisible realities of money that most people are too busy consuming to notice. The trap begins with a fundamental shift in how the automotive industry sells vehicles. They no longer sell you a car, they sell you a monthly payment. When you sit down at the dealership, the first question is rarely, what is the total price of this machine? It is almost always, what do you want your monthly payment to be? This simple question is a psychological trap. By focusing your attention exclusively on the monthly cash flow, the dealership can manipulate the length of the loan to make an unaffordable luxury vehicle appear completely affordable. We have normalized 60, 72, and even 84-month car loans. Think about what that means. You are committing a significant portion of your future labor for the next 7 years to an object that is rapidly destroying its own value. And this leads to the second layer of the trap, the depreciation engine. A vehicle is not an investment, it is a depreciating consumer good. The moment you drive a new car off the lot, it loses approximately 10 to 20% of its value. When you finance a depreciating asset, you are fighting a mathematical war on two fronts. You are paying interest to the bank, while the underlying asset aggressively bleeds value. Within 2 or 3 years, you reach a highly dangerous intersection. You owe more on the loan than the car is actually worth in the real world. In the financial industry, this is called being underwater or having negative equity. This is exactly where the true trap springs shut. This is the treadmill. Around year 3 or 4, the novelty of the car wears off. It has a few scratches, the tires need replacing, and right on schedule, the dealership sends you a letter. They tell you that your vehicle is in high demand and they can put you in a brand new model for the exact same monthly payment. To the financially uneducated, this sounds like a victory, but it is a carefully designed illusion. What the dealership actually does is take the negative equity from your current car, the thousands of dollars you still owe, and they quietly roll it into the new loan. You are now paying interest on the new car, and you are still paying interest on the ghost of the old car. Without realizing it, you have transformed a temporary loan into a permanent subscription to a liability. You never reach the promised land of a paid-off vehicle. You simply lease a depreciating lifestyle while pretending you own it. The third and most devastating layer of this trap is the invisible opportunity cost. Let us look at the silent math. The average new car payment has surpassed $700 a month. Many high earners are paying over $1,000 a month for luxury SUVs and trucks. If you take that $700 a month and instead of sending it to a depreciating piece of metal, you consistently invest it in a broad market index fund, yielding a historic average of 8%. Over a 30-year working career, that $700 a month does not just buy you a few nice cars, it compounds into over $1 million in autonomous wealth. When you sign that 72-month financing agreement, you are not just buying a car, you are sacrificing your future freedom. You are trading a $1 million retirement for heated leather seats and a newer infotainment screen. So, why do we do it?
Why do highly intelligent, high-earning professionals fall completely into this trap? Because cars are the ultimate symbol of visible success. In a society that judges your worth by your possessions, driving a simple 10-year-old paid-off car feels like a failure, even if you have $1 million in the bank. We have been socialized to prefer visible poverty over invisible wealth. A heavily financed luxury car is a loud announcement to the world that you have a high income, but true wealth is silent. Escaping the car payment trap requires a radical shift in ego. It requires the discipline to look at a vehicle purely as a tool for transportation, not as an extension of your identity. Break the cycle. Stop subscribing to depreciation. Reclaim your monthly cash flow and direct it toward assets that actually grow. If you found this perspective valuable, consider subscribing to Bruce Invests. We'll keep exploring the calm, rational realities of money. Thank you for your time.